Welcome you all to the first session on the third lecture of the fourth lecture, which is investment decisions. So, in this topic, we will be able to discuss the nature of the corporate investment decisions and to explain the investment appraisal process and to apply the main investment appraisal techniques and to recognize the limitations of the main investment appraisal techniques. So after completing this session, you will be able to get a clear understanding about what the main investment appraisal techniques and how to apply those investment appraisal techniques in your calculations. Right, so moving on to the next slide, that is the nature of the corporate investment decisions. And the investment decision of a firm are generally known as capital budgeting or capital expenditure decisions. So what do you mean by the investment decision or the capital budgeting or capital expenditure decisions? So those are the types of investment decisions that are conducted in a long-term perspective that involved in a huge amount of money or a large sum of or large scale of money. And the firm's investment decisions would, these type of investment decisions could includes expansion, acquisition, modernization, and replacement of long-term assets. So if I tell you an example, so let's say if a firm is planning to acquire some machinery or some equipments or some production plant, so then it will come under this investment decision, because those machinery that they are using for their production are long-term assets, and since they are long-term assets, so those long-term assets will be used for more than 1 year's time period, and that the decisions that the company is taking to acquire these production plants or the machinery will become an investment decision. And on the other hand, if the company is planning to expand their business by acquiring or by taking another plant, or by building some buildings, or taking decisions to expand their business by increasing their geographical expansion, then that will also become an investment decision, because from all these types of decisions that planning to expand their long-term assets, and they're planning to acquire some long-term assets that are used for the company or for the company's main business purposes. And the acquisition, modernization, replacement of assets can also be taken or categorized as the investment decisions. So if you are having an existing plant that is used for production purposes, and if that plant is not working properly, and if you want to replace that plant, then what you can do is you can purchase a plant, or you can acquire a plant that provides the same benefits or same purpose, or do the same purpose. However, if you are going to replace the existing production plant or existing machinery by purchasing a new machinery, then it will become a replacement of long-term assets. Then all these things, that means the expansion, acquisition, modernization, and replacements, are coming under what? Coming under the investment decision. And also the sale of a division or business, that means diversification, divestments, is also known as investment decisions. Right, and the decisions like the changes in the methods of sales distribution or an advertisement campaign or research development program have long-term implications for the firm's expenditure and benefits, and therefore they can also be evaluated as investment decisions. So if you do some sales distribution, if you do some kind of research and development programs, and if that has a long-term implication for the company, then that will be considered as a investment decision. So those are the types of investment decisions that a company takes. And with that understanding, we will move forward. So here you can see the features of investment decisions, right? The first feature is the exchange of current funds for future benefits. In an investment decision, what you do is um you exchange the current funds for future benefits. So if, as in the first lecture onwards, I have told you that when you are purchasing a car, when you are purchasing an asset, that means you're using you're spending your current funds to earn future, or to have future economic benefits. Therefore, if you are purchasing some long-term assets, or if you are doing some capital budgeting decisions, so what you do is you are exchanging current funds for future benefits. Current funds in the sense money, it can be an existing machinery, or it can be some other sources of funds. However, you are exchanging those funds for future benefits. Right, and also the funds are invested in long-term assets. You are exchanging the current fund for future benefits, and also the funds are invested in long-term assets. If you are considering about exchanging the funds to purchase short-term assets, then that will not become a capital budgeting decision, since that purchase involved short-term assets. If it is an investment decision, it has to become long-term assets, and the future benefits will occur to the firm over a series of years. And if that asset is a long-term asset, that should have that should incur future benefits to the firm over a series of years. If that asset generates the benefits for only one time period, then it's not an investment decision or a capital budgeting decision. If it is a capital budgeting decision, the current funds should be transferred, and the funds should be invested in long-term assets, and then the benefits should occur to the firm over a series of years. Right. And moving forward, the importance of investment decisions. Right. So these are the importance of investment decision. Taking an investment decision is important for growth perspective. Right. If you want to grow the company, or if you want to expand the company, if you want to grow the company, or if you want to modernize the company for growth perspective, then moving to or going for towards an investment decision is important. And the next one is the risk perspective. If that company is only involved in a particular product, or it only produces a particular product, and if that product is highly risky, if that company wants to reduce the type of risk, so then the investment decisions are important. When you're taking capital budgeting decisions, or when you're investing in long-term assets, you have to consider the risk of that particular asset. And then funding. So when you are doing the investment decisions, you have to focus on the funding. Right? Funding in the sense you have to have an idea of how you're going to like fund the business, and how you're going to make the purpose. So all the go to make the purpose or fulfill the purpose by putting funds. So then the funding is also important. and irreversibility. So if you like, since the funding is very large, since the capital budgeting decisions involved huge amount of funds, so it is known, it is like identified that the investment or the capital budgeting decisions are irreversible, having the feature of irreversibility. So that means if you have taken the if you have taken an investment decision, and since it involved a huge amount of money, the decision cannot be reversed back. So if you have taken a decision to purchase a machinery for your production worth of uh, you have decided to purchase a machine worth of 50 million for your production purposes. So then if you have purchased that machine by paying 50 million, if that machine is not worthwhile, or if that machine is not working properly, you cannot reverse that, or you cannot reverse that funding back, or you cannot give that machine back, since that involves a huge amount of money. So then those type of decisions, or those type of investment decisions are having the feature of irreversibility. And the next one is the complexity. So when you're making an investment decision that involves a complex process, so it has to go forward, and it has to go along with some steps to follow. And you have to go with some steps that you need to follow. So you have to do some evaluations, you have to do some analysis, you have to see whether this investment decision involves in this type of growth facility and growth perspective, and it involves this type of risk, how we are going to mitigate that risk, how we are going to fund that project, and how we are going to return the economic benefits to the company likewise. So since you're going forward, and since you're analyzing the investment decisions in order to get the most out of it, then that comes under the complexity, that can be classified as a complex process, right? So it is important, the importance of investment decisions can be categorized into five sections. The first one is the growth, the second one is the risk, the third one is the funding, fourth one is the irreversibility, and the complexity. So the investment decisions involves in growth perspective. So investment decisions are done mostly to grow the company, and it bears a high risk, and it involves a huge amount of money or huge amount of funding. And the decisions that are taken to purchase long-term assets or make investment decisions are irreversible, and it involves a very complex process. Right. So with that, we will move on to the types of investment decisions. Right. So there are two classifications to classify the types of investment decision. The first classification is as follows: the expansion of existing business, the expansion of new business, replacement, and modernization. So those are the three. The first, under the first category, those are three types of investment decisions that a company is taking. So that is the expansion of the existing business, the expansion of a new business, and the replacement and modernization. And apart from that, there's another useful way to classify the investments. So those are the mutually exclusive investment, independent investment, and contingent investments. All right. So what do you mean by these mutually exclusive investments? That means if you have so let's say you have two investment avenues, right? That is X and Y. So the X includes 100 million. X includes 100 million rupees for investment. Y also includes 100 million rupees for their investment. Then if you have if you think that there are benefits, or if you think that investing in all these or both these projects are worthwhile, what you can do, you can uh, you can select, right? You have to, like, I will explain you like this. So there are two investment avenues, right? X and Y. And you think the investing in X is worthwhile, and then if when you come across of investment avenue Y, you think this investment in investing in Y investment avenue is also good. However, if you are going forward with this mutually exclusive investment, you cannot select both of these projects, right? If that investment is mutually exclusive, you have to analyze these projects and you have to only select one based on the benefits, or based on the calculations, or based on the investment decisions that you're going to make. Even though these two projects provide positive cash flows, and investing in both these are providing benefits, you cannot invest in both. You have to select only one. In a mutually exclusive investment, it says mutually exclusive. If you evaluate two projects, the selection of one project will exclude the selection of another project. If so, it is known as a mutually exclusive project or mutually exclusive investment. The selection of one will exclude the selection of the other investment. And if it is independent investment, so if you have both X and Y, and when you do the analysis, you find that investing in both is good, right? And investing in both these projects are worthwhile or beneficial. Then, since these are independent investments, what you can do, you can invest in both the avenues. So it in like investing in one avenue does not forego the invest or block the investment of the another avenue. So if the investment of one avenue blocks or excludes or rejects or blocks the investment of another investment purpose or investment project, then that is a mutually exclusive. If you can select both of these without any restrictions, then it is an independent investment. And when it comes to the contingent investment, so you are having two projects, and if one project fails, so you can have the ability to go forward with another thing, right? So that is known as investment types of investment decisions, right? So moving on, we will come across with the investment appraisal process. So in an investment appraisal process, so there are several steps, right? The first one is proposal generation, and the second one is the proposal generation, and that is if you have a investment project, so you have to generate a proposal, right? So if you want to purchase X machine, right, you can in a company you cannot go straight away and purchase that X machine. What you have to do is you have to generate a proposal stating that the needs of this machine is this, the specifications are this, so we can have these types of like these type of benefits when you are investing in this, the cost is this, the benefit is this, and you have to do a thorough analysis. That is the proposal generation. So you have to like go across with all these things that we need to come across when investing in these types of projects, and then by evaluating that, you have to generate the proposal. to state that it is worthwhile to purchase this type of a, oh, it is beneficial for the company to purchase this type of a machinery. And then after you give that proposal, the proposal will be reviewed and will be evaluated, right? So the finance division or the finance managers evaluate these proposals by using the investment appraisal techniques. So you will learn these investment appraisal techniques one by one. So by evaluating these investment appraisal techniques, they are making a decision. That means by evaluating these investment appraisal techniques and based on their results, so you can see, or you can you can conclude that investing in this project is good or bad based on this technique 1, technique 2, technique 3, technique 4. And by evaluating all these techniques, you can have a decision. And then after making a decision, you can implement the decision. And if that decision is to purchase that particular machinery, so you can implement that, or you can go ahead and you can purchase that machinery. And the follow up and control is also important, because even though you have purchased this particular machinery, you have to go and see and follow up whether this machinery is working properly, and whether the like whether the stated benefits are coming to the company. So you have to evaluate that. Even though you have purchased the particular machinery that is proposed by the company or the finance managers, so you have to follow up and see whether those benefits are received to the company. And you have to do the post implementation audit. So that is by evaluating this, and in the proposal or in the evaluation stage, they have mentioned these amount of benefits will be generated. However, the actual is this estimated versus actual, right? Is this. So you can have that type of a analysis, right? So that those are the investment appraisal process. And the next one is the investment evaluation criteria. There are 3 steps that are involved in the evaluation of investment. The first one is estimation of cash flows. So when you're evaluating the investment decisions, or evaluating an investment, the main thing that you have to evaluate is the cash flows. So you have to, even though you get some profits, or even though we discuss about how much of profits that we get by using this particular investment, or by having this particular investment in the company, you have to focus on the cash flows. Cash flows is important, and you have to estimate the cash flows. And the estimation of the required rate of return, or the opportunity cost of capital. As I told you previously in the previous lectures, the required rate of return is the minimum rate of return that an investor is expecting for their investments. So if that minimum required rate of return is received by an investor, then only he will invest in the business in a particular investment avenue. So we have to firstly calculate the cash flows, and then we have to calculate the required rate of return. And after calculating the required rate of return, we have to apply the decision rule for make the choice. So for each and every investment appraisal technique, we have the decision rules. So by evaluating those investment appraisal techniques, we have to go according with the decision rule and make the decision whether to go ahead with that particular investment or not. So as I given you here, there are 3 steps that are involved in the evaluation of an investment. So the first one is the estimation of cash flows, which is really important. And the next one is the estimation of the required rate of return. And next is the application of the decision rule to make the decision, right? So the investment evaluation criteria. So under these investment evaluation criteria, we have categorized the investment evaluation criteria into 3 types. As I told you previously, we after after we give the proposal, we have to analyze the investment avenue by using the investment evaluation criteria. Right? The criteria is segregated into 2 types, that is non-discounted cash flow techniques and the discounted cash flow techniques. So the non-discounted cash flow techniques has only two uh, uh, investment techniques, or the criteria evaluation criteria, that is the payback, and the next one is the ARR. Right? And in the discounted cash flow techniques, we have the discounted payback, the NPV, the IRR, and the profitability index. So for your purpose, we are not discussing about the IRR here and the profitability index. Right. So it is important for you to learn all these things. We will learn about all these investment evaluation techniques, and we will learn about the decision rules of each criteria. Firstly, we will go towards the payback. So firstly, we are discussing about the non-discounted cash flow criteria or cash flow techniques. So under that, the first category is, or the first criteria or the first technique is the payback period. Payback is the number of years required to recover the original cash outlay invested in a project. So you have in the payback, what you are calculating is, we are calculating the number of years required to recover the original cash outlay invested in a project. So you have some cash flows that you invest, or you have some investment that you make for your purpose. And here in this cash payback technique or payback period method, so we are calculating the number of years required to recover the original cash outlay invested in a project. So each and every project we are putting a original cash outflow or original investment. So here we are seeing whether how many years that we need to wait to get the initial investment back. So that is calculated under the payback. If the project generates the constant annual cash inflows, the payback period can be computed by dividing the cash outlay by the annual cash inflow. All right. So we have the initial investment. So that initial investment is given, and the annual cash flow is also given. Right. So you can see by dividing the an initial investment by the annual cash inflows, you can get the number of years required to recover the original cash outlay. Right. And the example number 1, it says that a project requires 50,000 rupees and yields an annual inflow of 12,500 for 7 years. Right? Then the payback period is, so we will take this cash outlay as 12,000, right? Not 12,500, right? Then the initial cash outlay is 50,000, right? Initial cash outlay is 50,000, and initial cash outlay is 50,000, and the cash inflow is 12,000, right, for 7 years. Then what you are getting, how we are going to get this 12,000? So then what you have to do is this. So here you're like here the it is the annual cash inflow is 12,000. So then if it is 12,000, you have to divide it by say 0 and initial CI or C. Then you will get 50,000 divided by 12,000, or else then 4 years. If we take this 50,000 divided by 12,500, it'll give you the answer of 4 years. Right, so this is a printing mistake, right? Typing mistake. So this should be 12,500, right? If it is 12,500, then you have to divide this initial investment by the number of the annual interest, annual cash flows. Then you will get the payback of 4 years. And this can be easily calculated, or the payback can be easily calculated like this, only if the cash inflows are equal, right? So here it says it has the same cash flow, so 12,500 cash flows for all 4 years, all 7 years. Then we can straight away calculate and take like this. However, if that is not the case, or if that is not happening, or the calculation is or the cash inflows are totally different in each year, so then you cannot just take and divide the initial cash outlay by the annualized cash inflows. Then you have to do some kind of a calculation, right? So this is another example that are having that has unequaled cash inflows. So it says that suppose that the project requires a cash outlay of 20,000. Right, I will do the calculation here. Cash outlay of year 0 is 20,000, and year 1 it generates 8,000, and year 2 it generates 7,000, and year 3 it generates 4,000, and year 4 it generates 3,000, right? So then if the cash flows are not equal, what you have to do, you have to calculate the cumulative cash flows, right? As it was mentioned here, unequal cash flows. In case of unequal cash flows, the payback period can be found by adding up the cash inflows until the total is equal to the initial cash outlay. Right, so you have to add this. Right, so here you have the initial cash outlay of minus 20, and if you add plus 8,000 to the minus 20, you will get minus 12,000. Right now, the money is not received yet, and then you have to add 7,000 to 12,000, right? So then what will be the answer? It is minus 5,000. Then you have another 4,000 received in the third year. So then you have to add 4,000 to the 5,000. Then you will get another minus 1,000. So until the third year, you won't recover your initial investment. However, by looking at this, right? By looking at this, you can identify that here you have to only recover 1,000 rupees. However, in year 4, you have got 3,000 rupees. So However, by looking at this, you know that in 3 years you will recover the whole amount. However, in 4 years you will recover between year 3 and year 4 you will recover the full initial investment. However, in the calculation we have to find the exact number of months that we need to that we require to calculate, or that we need to recover the full investment. So by looking at this, you can see that exactly it has 3 years. However, there are some months months are remaining to recover this, right? In order to find how much, or how many months that we need to recover that initial investment, so you have to do a small calculation. That is, you have to divide this 1000, which is the minus figure, or the cumulative cash flow, by 3000, that is the cash inflow of the next year, and multiplied by 12. Why are we multiplying by 12? Because we have to find the number of months. If you need to find the number of weeks, then you can multiply it by 52. If you need to find the number of days, you can multiply it by 365, right? So by multiplying, by dividing 1000 by 3000 and multiplying by 12, you get 4 months, right? Then the payback period is 3 years and 4 months, right? So that is all about the payback period. So in the acceptance rule, the payback a project would be accepted if its payback period is less than the minimum standard payback period set by the management. So when you are given a question, or when you are given a question, so you will give a minimum standard payback which is set by the management. If the calculated payback, or the estimated payback, or the project's payback that you're calculating is less than the standard payback period which is set by the management, then you can accept that particular investment. And as a ranking method, so if you are given 2 to 3 projects, more than one project, then you have to rank, or if you're asked to rank your projects, so then what you should do, then it gives the highest ranking to the project which has the shortest payback period, and the lowest ranking to the project which has the highest payback period. So if the payback period is lesser, then the investment, then what you can see, then the investment will be recovered quickly or faster, right? So if it is good if the payback period is having a lesser number of times, or is less, right? So if you are going to rank the project, so if there are project y, x, y, and x, y, and z, and if the payback period is 3 years, 2 years, and 5 years, right? So when you're ranking the project, or when you're ranking the projects based on the payback period, so you have to rank or give the first priority, or the first ranking to the project which is having the lowest payback. So that is the project Y. So if then project X and project Z. Z is given the lowest ranking because it has the highest payback periods. Why they are having a highest payback period? Because the investment, or the initial investment, will be recovered at a later date. Right? So then that kind of an investment is not good. With that, we will move on to the evaluation of payback. Right? So when evaluating the payback, what you can identify is that there are certain benefits of payback. Right? So what are the benefits? So you can see when we are doing the calculation, it is very simple to do the payback calculations. So it is a benefit that we can identify, so anybody can understand how we are going to do the method that we are using to calculate the payback. So it is really easy because the initial investment will be divided by the annual cash flows, and so any person can understand, and it is really easy, or really it's a really simple method that we are using to calculate the payback. So the simplicity is there, and it is cost effective. So if we are using a very complex method, and if it is time consuming, and if it requires a skilled labor, then it will be hard for us to calculate the payback. So then, since this payback method is really easy, and anyone who has the who knows the initial investment and the annual cash inflows can calculate straight away, go and calculate the payback. So then it is cost effective, right? And it has short term effects. So by analyzing this payback period, so we can have short term effects, and we can analyze and do short term calculations to the payback period, right? So and also the risk shield. When you're having when you're using the acceptance rules for the payback, so that is where you are that is where you are calculating the that is where you are giving the highest ranking or the highest ranking for the project that has the lowest payback. So lowest payback in the sense that you're uh, lowest payback in the sense you're receiving the initial cash flows very quickly. So if you're receiving the cash flows very quickly, you will be exposed to a low amount of risk, because you will be able to invest those money that you get in another investment avenue. Then the risk shield is very high. Right, so therefore, it is very good to have payback period, and to evaluate payback period, and get the investments in the payback period that are having the lowest payback. And you can have an understanding about the liquidity. Since we are since we are trying to accept the projects that are having the lowest payback, that means we can recover our money quickly. So if we can recover our money quickly, then it is good for the investments that we are doing, right? So then that is really good to have the liquidity purpose, and to evaluate that along with the liquidity purpose by using the payback. And further, there are serious limitations in payback. The first one is the cash flows after payback are ignored. So if I go to this example, right? So at the time we are explaining, and at the time we are doing the calculation, we have calculated that cash flows, cumulative cash flows, likewise 0, 1, 2, 3, 4. So we got 1000 minus 1000 and 3000. So you know that this money will be recovered in 3 years and 4 months, right? So in order to fulfill, or in order to complete this project, we have already almost 4 years. We have to spend almost 4 years. However, the initial investment will be covered in 3 years and 4 months. What about the rest 8 months, right? What about the rest 8 months? Are we talking about that? No. So we are calculating the payback period in order to see how long we are taking to recover the investment. After we recover the initial investment, we are not concerning about this thing, or this the cash flows that we are generating after the payback. Only thing that we are searching, or that we are concerning about, is the time period that we are requiring that we require to get the initial cash flows, right? And that is a serious limitation because we ignore the cash flows after payback. And the next one. So we ignore the cash flows, right? So cash flows after payback are ignored. So we ignore the cash flows and we are concerning about the time period. So we are not thinking whether like so if I take you an example and explain, right? So we are having cash flows here and cumulative cash flows here. In year 0, we are having 10,000. Years, cash flows, cumulative cash flows. Right, year 0, we are having 10,000. Right, year 1, we are having only 1,000 or receiving 1,000. And year 2, we are receiving 2,000. Year 3, we are receiving 3,000. Year 4, we are receiving 8,000. Right? However, 8,000. However, when we are calculating, we are just trying to focus and we are just trying to get the answers to see whether how long we are taking to recover the initial investments. However, are we considering these cash flows or whether that the pattern of cash flows and how much money is received in the first 3 years or the first year, or how are we going to receive, or how much of money are we receiving in the last years, right? So we are not ignoring those cash flows. We are ignoring those cash flows. So that is why it is known as a serious limitation. And also the cash flow patterns are ignored. So the cash flows can, or the payback period can only be calculated if we are having the cash flows like this. Firstly, we have to have the initial investment and then the cash inflows. If we have the cash outflows here and there are some other patterns that we are having, so then we can so then we can't then we can't do the calculations of payback, right? And then the administrative difficulties. So we have administrative difficulties when evaluating the payback or when calculating the payback. So it is hard to calculate, or it is hard to get the cash flow patterns. It is hard to get the short-term effects, and it is hard to get the cash flows that are generating. So those have the administrative difficulties, and it is inconsistent with the shareholder value. So we are trying, the ultimate objective of finance is to maximize the shareholder value or to maximize the shareholder wealth. However, in this cash flow or in this investment appraisal technique, what we are concerning is that we are concerning about the time period that we can receive the initial cash outlay. So then it is inconsistent with the ultimate objective of finance, right? Then we are moving on to the next non-discounted cash flow technique, which is the accounting rate of return. Right. So the accounting rate of return is the ratio of the average after-tax profit divided by the average investment. The average investment would be equal to half of the original investment if it were depreciated constantly. Right. So we have to previously under the payback period, we calculated the cash flows. However, only on this accounting rate of return, we are calculating the average accounting profits. That is the average after tax profit divided by the average investment. So we are dividing the average investment by the after tax profit. And average investment is equal to the half of the original investment or CO divided by 2 is the average investment. But the variation of accounting rate of return method is to divide average earnings after taxes by the original cost of the project investment instead of the average cost. So that is the accounting rate of return technique. So we are here calculating the we are dividing the average earnings after tax by the original cost of the project, right? So here we are having an example. It says a company is evaluating a project with an investment of 100,000 with its expected ending value of 20,000 after 5 years time. The company uses straight line depreciation. Revenue expected from the project for 5 years are 300,000, 200,000, 400,000, 500,000, and 100,000 respectively. The cost of sales is to be 30,000 of revenue, and the fixed cost per annum would be 20,000. Evaluate the project using ARR technique if the company's target ARR is 100,000. So here we are given a company's target ARR, and we have to calculate the company's ARR and see, or the project's ARR and see whether this project is worthwhile. So I will explain, or I will do the calculation. Right. So the accounting rate of return, ARR, is equal to average accounting profit divided by average investment, right? So here we have the years, number of years, that is 5, right? 1, 2, 3, 4, 5. Then we have the revenue, 300,000. I will use in thousands, right? Since I don't have the space, so you can use either by 1,000 or the normal figures. 200,000, 400,000, 500,000, 100,000, right? Since the ARR has to, in order to calculate the ARR, we have to calculate the average accounting profit. Accounting profit is profit after tax, or profit before tax, right? So it is profit after tax, right? Profit after tax divided by average investment. Right, so in order to calculate the profit after tax, how we are going to calculate the profit after tax? So firstly, we have to take the revenue, and then we have to take the cost of sales. That is, the cost of sales is 30% of the revenue, right? 30% of 300,000 is 90,000. and 30% of 200,000 is 60, right? 120, 150, 300, right? So then you get the gross profit. Gross profit is 210, 140, 280, 350, 70. And then the depreciation is straight line basis. The investment value is 100,000 and you have a ending value of 20. Then the number of period is 5, right? So then the depreciation is 16,000, right? So then you get 16,000. So how are we, like, what are we doing here? We are calculating the profit after tax, right? So that is the thing that we are doing. And then there is a fixed cost, right? There's a fixed cost per annum, that is 20,000. That is 20,000. Then we are calculating the profit, that is 174, 104, 244, 314, 34. And in order to calculate the average accounting profits, we have to calculate the total accounting profits by summing all these, by taking the summation of this, right? The summation of this is 870,000, right? Then the average profit is 870 divided by number of years, that is 5. Then you get 174,000. Then the average investment is 60. How we are going to get the 60? The initial investment is 100 and you have a ending value of 20 that is added and you divide by 2, then that is 60, right? 60,000. Then ARR will be 174 divided by 60 into 100. Then the answer will be 290%. Then the target ARR is 100. Then the investment is accepted because the investment is higher. The project generates higher return than the target ARR, right? So then you can identify the acceptance rule as well. The project is accepted if the project generates a high IRR, higher IRR compared to the target IRR, right? And there are also evaluation methods or certain merits and serious shortcomings of ARR technique. So just like payback method, the accounting rate of return is also very simple to calculate. So you can calculate this accounting rate of return by taking the accounting data. So you can use the accounting data. You have the revenue, you have the cost of sales, you have the depreciation amounts, you have the other costs that are calculated. So by taking all these things into account, you can calculate the ARR. So because the accounting data is already available, it is really easy. And you can use the accounting profitability also for calculations. So you don't need to do very hard and fast calculations. What you need to do is you can calculate by using the accounting profitability. And also there are serious shortcomings of the this ARR method. The first one is the cash flows are ignored. So you cannot in the ARR method, the cash flows are ignored since it only considers about the profits, profit after tax, and the depreciation and other things. So the cash flows are ignored, and the timing of cash flows are ignored. So you are taking time or taking cash flows for a longer time period, but you are not considering about the time value, or you are not considering about the time value of money. And arbitrary cutoff. So even though you have the risk plus profits or um, risk plus earnings, so that will be the profits that we are incurring is concerning about the is considering or is having an effect of the risk, but you are not considering about that aspect. So that is also a serious shortcoming of the ARR method. With that, we conclude the first part of the investment decisions.